this is to help a lot of our mutual clients and also people who have people that they know that have issues with taxes, with estate planning. And with taxes, I know James Bell is an MD with Faber Tax Solutions. And people actually go to him when they have tax issues or CRA audits them. With our Brad Cohen, who is a financial security advisor, also with Faber, and he also does a lot of estate planning for a lot of the clients. And I think it's so key for us, us as a team, and also us as knowing our clients, to help them navigate through a lot of questions that come across that they may not have the solution in one place. So we are hoping that once James and Brad does their presentation, they actually can answer questions related to some of the challenges that people are facing. And they're going to give you examples of what currently that they have dealt with, tax issues, estate issues, because at the end of the day, most of us on this call spend a lot of time actually trying to save a lot of money.
Right.
And, one is for the family. They try to save to make sure everybody has a good living. The other one is for making money so that CRA takes the less amount of money, right? So that's another thing also we want to try to, engage here, how it all goes by books, but what are things that we can do to make sure, that we keep as much money that we make, right?
Right. And that's kind of why we're both here. I'm kind of the beforehand, let's plan, let's get things ready. And James is, what if something goes wrong?
Yeah. And
am I correct?
Yeah.
You are absolutely correct.
And James has been with working with CRA for quite some time, and then you went into your private practice. Is that what it is?
Yeah, I spent over 22 years working at the Canada Revenue Agency in all their major program areas, and I left there about 11 years ago, and now I help people with issues with the CRA.
Right, yeah. And that's why we need James and, Brad here to really help you through a lot of challenges people have faced, and then help you say, okay, make sure that we don't make the same mistakes that people come to you for when CRA audits and all that, right? Yeah. So I think maybe we could then now start. And I think what we could do is first we'll start off with James and, go through the presentations. I know we did get a lot of questions beforehand, and some of the questions that were asked, James would cover some of it. And then there are other questions that we received too. And you can actually on the chat, there is a whole bunch of questions that have been asked. You could actually on the chat, send those questions. We may not be able to answer all the questions that are here, but we are also creating a WhatsApp group that, any questions that were asked here would be posted, or something that you didn't get an answer will be posted too. And I think our office did send you the link if you wanted to join the WhatsApp group. So yeah, so without further ado, I'll ask James to start off with his side of the information session.
Yeah, thanks very much, Tom. Now, should I be in charge of the presentation and rolling the screen forward?
Tara was actually going to help you go through the presentation.
Great.
And so this is something that, work in progress.
Right.
So as we are talking, things are getting ready. So
I'm not noticing anything in the background whatsoever.
Yeah.
Absolutely. No, I'll be happy to talk about the CRA and some of the issues that relate to some of the real estate specific transactions and how the CRA might fit into that.
Yeah.
So one of the most common questions that I get, well, will the CRA audit me, and what are my chances of getting audited, and can I even reduce the chances of getting audited somehow? Well, with regard to real estate transactions, I don't think it's a big secret. The CRA is really focusing heavily on auditing real estate transactions, most particularly in the Toronto and Vancouver areas. Now, there's no foolproof way of reducing the chances of getting audited. And I used to be an audit manager for many years at the CRA, and I've done these things on both sides of the fence. But if you, if you're purchasing a property, for example, if you hang on to it for more than 12 months, that's a good thing. The CRA does tend to look at focus on properties that are held for less than 12 months in terms of the date of purchase and sale. And of course, the property could be used for many different things, your principal residence or an investment property. So when you do dispose of it, make sure you do report any gain and classify the gain properly. So because all these questions will get asked if you do get audited, so you want to be well prepared in terms of that. Now, and so I mean, what might trigger an audit? Okay, so in terms of real estate, again, the CRA would look at number of transactions conducted. The more that you conduct, there's nothing wrong with that, but it does tend to get the CRA's attention, especially with regard to the period between all of the purchases and sales of these properties. The shorter the period, the more likely that they would take a review. And again, there may not be anything wrong with any of this. I'm not saying there's anything wrong with these purchases and sales, not at all. But the CRA does tend to take a look at these things. They will check to see if any gain was realized, reported on your return, and they want to make sure that the gain is classified properly. For example, was it a capital gain or was it a gain on account of income? There's a difference, obviously. The capital gain is reported at 50%, and the income gain is taxed fully. So, and really, it's what's most important. What do you do if you get selected for audit? Well, in terms of, again, real estate transactions, the CRA audits typically start off with a letter and an associated questionnaire. Well, they're going to ask several pages worth of questions in terms of when you bought the property, how you financed it, who are the owners of the property. Many of these questions the CRA will already know the answers to, but they want to check to see, if your answers cross-reference with their answers. In terms of that questionnaire, it's very important that you realize that the answers to those questionnaires will largely impact the results of the audit. So my advice is, listen, don't respond to the CRA until you've consulted a tax professional, and because again, that would have a significant impact on the ultimate outcome. If you respond first and then come to a tax professional once the difficulties start, it's difficult to, perhaps I can put it this way, put the toothpaste back in the tube.
Mm. Yeah.
Now, if you get audited or if you file a tax return with a significant gain on it, there could be practical issues about paying the tax bill. Now, when you file a tax return or you get an assessment or you get reassessed, the CRA cannot make you pay that debt for at least 90 days from the date of that assessment or reassessment. The interest will continue to accumulate on the debt, but enforcement action can't take place. That does not apply to Excise Tax Act HST assessments. Those debts become collectible immediately. Now, the CRA, how do they collect? Well, I mean, they can certainly freeze your bank account, garnish your wages, put a lien on your home. They also have the power to seize and sell your assets, including your home. Now, they generally don't seize and sell your home, but they certainly have the power to do so, but they would usually settle on putting a lien there. If you don't have the ability to borrow the money or pay the debt off as quickly as the CRA would like, negotiating repayment terms, that's possible. We certainly do that. But it's important that we get the deal in writing. Verbal agreements with the CRA collector really hold no weight whatsoever, and it must be in writing. So we get these agreements in writing to protect your rights against the CRA taking any action against you. Now, in terms of overall tax debts and other debts that you might have, sometimes, listen, a person just finds themselves in an unfortunate position of not being able to repay their tax debt or other debts at all. And so if that's the case, again, there are other options available to you, including what we would call a proposal. And those proposals are made to your creditors, and the ultimate goal is to settle the debts for less than 100 cents on the dollar, perhaps as low as 30 cents on the dollar. That would be possible in certain circumstances, depending on your financial situation. So don't give up hope if you do have debts of that magnitude that you're struggling to pay. Now, filing, I mean, the CRAs has lots of deadlines and certainly love to apply penalties and interest wherever they can. The deadline to file a personal tax return is April 30th, and if you're self-employed, the deadline is June 15th. The first time that you file your personal tax return late, the first day that it's late is a 5% penalty, which is calculated on the tax balance. The penalty continues to increase at 1% a month to a maximum of 12 months or 17% in total. Again, all of these penalties are calculated on tax owing. Now, if you file the next year late or the next year, those late filing penalties increase very quickly and can exceed 50% of your tax balance. And that would be quite a drastic and significant penalty.
Wow.
Yeah, that's quite a bit.
It's large, absolutely. Now, in terms of, on top of the penalties, of course, there's everybody's favorite, the interest part of it. Now, interest will be applied to your tax debt if you haven't paid it on the due date of the filing, April 30th, as an example. The current interest rate for tax arrears is 10% a year, but that's compounded daily, which makes the effective rate closer to 11%. Now, and that interest is charged not just against the tax, but it's also charged on the penalties as well. And also at some point, of course, the interest will start compounding against the interest in addition. So your tax balance, if you get penalties and interest, can certainly spiral out of control very quickly. Now, in terms of the gains, going back to your real estate transactions, people say, well, what are the gains and what are the implications and which one should I choose to classify my property as? And like everything else, it's a question of facts. It's not really a choice per se. It's based on the circumstances of the property. There would be a gain, the income gain or capital gain would be called for. If it's your principal residence, then luckily, that gain would be exempt from your income and under the principal residence exemption of the Income Tax Act. If the property in question was not acquired and sold for business purposes, according to the CRA, they like to refer to that as house flipping as an example, then the gain in that situation would likely be recorded as an account of capital, and that gain would only be taxed at 50%. If the property acquired was indeed sold for business purposes, then the gain would be reported and taxed at 100%. The CRA, of course, prefers you to report the gain at 100%, and that's their default position when they come and ask you questions about your real estate transactions, and that's why it's important to consult with a tax professional if you are contacted about that. So in terms of a second property, what should you be aware of? Well, generally, for example, if the second property is a rental property, that entails that it would generate rental income, and that rental income must be reported and declared each year on your tax return. Of course, you will have expenses that you can deduct against the rental income, and again, getting a qualified tax accountant involved in that would be highly advisable. The sale of the second property, ultimately, when you do sell it again, keep in mind that the gain from that second property wouldn't be exempt from tax, as it would be for your principal residence. So again, the CRA will be looking to see that you've classified the gain correctly once you've sold. All right. Well, that's the end of my presentation. I'm sorry if I went over time, Tom, with that. My contact information is on the screen, and I'm very happy to talk to anybody, and we offer a free consultation. So please mention Tom's name if you do call. Happy to talk to anybody about their CRA situations.
Yeah. And also, I think, James, you were saying that, for example, if somebody hasn't filed taxes for a few years, there's something that you said, if you let them know that you actually didn't file, there's something that they let you get away with something as long as you disclose. So you was talking something, yeah.
That's correct.
If you
Yes.
can explain that.
Absolutely. Yeah, sure. Some people have, say, for example, haven't filed tax returns for a number of years even. I talked to somebody today that haven't filed tax returns for 15 years. Or some people have filed tax returns, but they haven't reported all their income accurately, as an example, and they want to correct that. The CRA has a tax amnesty program called voluntary disclosure. Now, that program, if it is successfully done, would result in the CRA waiving 100% of any and all penalties that would apply. And that's just not a late filing penalty. That could be a gross negligence penalty, which is a 50% penalty. There are a myriad of penalties that would cover, and it would cover every one of them. Also, it would result in the CRA waiving 50% of the interest that would normally be charged. Now, over a 10-year period, as an example, that interest could be at least as much as the tax in some cases. And not filing your tax return means you're not reporting income, which is tax evasion, and that's a criminal offense in Canada. Now, so the final benefit of the program of voluntary disclosure is the CRA will waive their right of criminal prosecution. So with the penalty and interest relief and the prosecution waiver, dealing with voluntary disclosure can be a very effective way of dealing with the non-filing. People are afraid when they haven't filed. They don't know what to do. They're afraid to come forward because they don't know what the CRA will do. Well, this is something we deal with every day and quite successfully.
Yeah, no, because we had, I think, a scenario where one of our clients, they had the property, I think about 5-7 years. And then one of the sellers hadn't filed for a couple of years. And then they have to get a mortgage. So the banks want to see the income,
Correct.
the filing from CRA.
That's right.
So they had to go and get that done. But it's good that, if you don't file, the CRA will let you get away with it as long as you disclose everything, right?
The main feature of the program, they'll let you come forward and they'll give you that relief if you go to them before they come to you. If they call you or they send you a letter and demand that you file, you can no longer use this amnesty program. So being proactive can mean the difference between tens of thousands of dollars in penalties and interest or not.
Right. Yeah.
And I'm going to assume the bank asking you to do it is not the same as the CRA asking you to do it.
Correct.
Good. Yeah, no, so that's good. So now what we plan to do is now, Brad Cohen is going to start his information session. And what he's going to talk about is estate and related. And his presentation is going to be a little bit longer than
I'll
James.
try to keep it low.
Yeah.
I did notice I actually ended up covering a couple of things that James covered, but I gave examples. So I'll try to go through that a little bit quickly.
Yeah.
But let's get to it.
Yeah. So go ahead. Yeah.
So my agenda for today, I'm going to talk about 4 main things. I'm going to talk about how to save to purchase a property, which I think anybody who's working on, especially a first home purchase in Toronto, it's kind of crazy. It's going to be important. The tax implications of having multiple properties, transferring property to your children, and the last thing is avoiding a massive tax bill to your estate, especially when it comes to real estate. A big caveat here, I'm not a lawyer, I'm not a tax accountant, I'm a financial security advisor. I help you plan for things, but my general way of doing things, my modus operandus, is to include a tax accountant in the discussions when I'm putting things together with my clients, so that we have everything on the table and we have buy-in from everybody that's a decision maker on the plan. So saving to purchase a property. Obviously, the most important thing you can do to save to purchase a property is actually save money. First and foremost is pay yourself first. I didn't put this on there, but it's part of any good financial plan is to make sure you put money into your own pocket even before you pay the rent or the mortgage or the taxes, because at the end of the day, assuming you're semi-diligent, you will find money to pay for all the things you have to pay for, but you'll skip savings unless you pay yourself first. So the government programs that are out there, primarily for first-time home buyers, or what qualifies as a first-time home buyer, for example, for the FHSA, which I'll get to in a moment, if you haven't owned a property in over 4 years, there's a specific thing. We can talk about that in person. But basically, RSPs, you can use up to $35,000 of your RSP money. You can take it out without any tax hit. You can use it towards your property, but there's a big caveat on that. It has to be put back into your RSP with RSP receipts within 17 years. You do not get a second the tax receipt. You don't get a second tax savings on that money. It goes towards the program or not towards the program. And you have to be diligent about it because you have to pay at least 1/17 every year. The second thing, the new account that just came out last year, which is the first home savings account. It doesn't have to be a bank account. It can be any kind of investment account as long as the investment company supports it. And basically you can put in $8,000 a year for up to 5 years. So a maximum of $40,000. You get all the tax advantages of an RSP that you actually get to write it off. But when you take the money out, as long as you apply it to a new home purchase, a home purchase that's new for you, then you don't get taxed on it at all. And that's one of the most incredible new features that's out there. All of these are only, like I said, if you qualify for the account and you don't currently own property. So we can talk about the details about that. Other strategies that we have, I always recommend to my clients, the first thing that they should do is build up their TFSA, their tax-free savings account. Again, it doesn't have to be a bank account. You can put it into mutual funds or stocks or whatever works for you. And the benefit of that is any growth becomes tax-free. So you put the money in, you put $150,000 in, it grows to 100,000. Now you actually have 100,000 to put towards your property, as opposed to just investing in an account where there's going to be taxes, etc. The second thing I often recommend to people is using whole life insurance, which in the States, they have the concept of infinite banking. We have a similar concept here. It doesn't work exactly the same as in the States, but it does work. And you can borrow against your life insurance policy and then pay it back on your time. And yes, there's potential taxes, there's potential interest, but all of these things, if you do them properly, can be worked out. And of course, there's just general unregistered accounts. You put it into, you call up your investment advisor, you say, I want to put $50,000 in, it goes to 100,000. You have to pay your tax on the difference, but you still have that money to invest. When it comes to multiple properties, James touched on this, but I'll just go through it quickly. So your primary residence, like I said, there's no capital gains as long as you've lived there for 12 months. Rental properties, cottages, vacation homes, any of those things, they actually have capital gains associated with them. And that can be at sale time, or if somebody passes away, it would be at time of death. And it's taxed to the person that passed away, to the owner. So the example that I'm about to go through in the next 2 slides is, let's say somebody has a $500,000 cottage. They bought a cottage for $500,000. It's now valued at $750,000. And that would result in a $250,000 capital gain on that property. Even though it's your own property, you use it half the time, but you can only have one principal residence. Mortgages, again, I'm going to talk to your tax accountant. My understanding, because I do not do tax accounting, my understanding is your mortgage on your primary property cannot be used for any reason whatsoever, or on your cottage or anything that's for personal use. But if you have a mortgage on a rental property that you're declaring income on, the interest on the mortgage can be used as a tax write-off. So you get a little bit of a benefit there, as well as other expenses regarding that. On your primary property or on any personal use properties, there's no advantage.
Cottage also?
Yes.
Okay.
When you transfer property, there's what's called a deemed disposition. And that would be if you transfer it to your child, you transfer it, you sell it, it doesn't matter. It's considered, even if you give it away for free, it's considered a deemed disposition. And there can be taxes on the estimated growth, as opposed to, like, if you, let's say you have that $750,000 cottage and you just give it to your kids, you're allowed to, it's legal, but you have to pay tax on any growth the day that you do that. Okay, and even if it's passed off in your will, your estate would have to pay those taxes. How to avoid that massive tax bill? So one of the things that I deal with my clients a lot is, especially cottages. A lot of my clients do have cottages in the property, in their family. They've had them for years. The kids, whether they want it or not, they want it to go to their children. And so they're like, no problem. I'll give that money to my children. I'll give the cottage to my children when I die. What they don't realize is that's all going to be taxed. And so we have ways of making sure that we can offset those taxes. Yes, the taxes have to be paid, but we can do it for pennies on the dollar legally with planning ahead of time. Some assets, for example, any kind of registered account, a TFSA or an RSP, would roll over to your spouse automatically. TFSAs start being taxed if they go to your children. They start being taxed on the day of death, but up until that day of death, there's no tax for any growth. And regardless of the type of account, assets are taxed before being passed on. So if you have an RSP with $100,000 in it, you're getting taxes if you had $100,000 added to your income for that year. That tax has to be paid before the children get the money. Real estate growth, as James mentioned, is generally taxed as capital gain with some exceptions. RSPs are taxed as complete income. As I mentioned, TFSAs are not taxed until there's a transfer of ownership, and unregistered accounts are taxed depending on how it's built. So it's a bank account, it's taxed as income. If it's invested in stocks, it could be depending on the stock or the ETF. It could be taxed as capital gains. It depends on how it's set up. Here's a quick example. Billy is a widower. He lost his wife a few years ago, passed away at the age of 90, had a good life, thank goodness. He wants to, and in his will, he's passing on everything to his kids. His primary residence currently worth 1.3 million. Is a cottage worth 750,000, like we mentioned before, and an RSP with $600,000 still left. He was doing well at age 90. So depending on the assets, I don't know if everybody can see this, it's a little bit small. The primary residence, that does not matter about the purchase price because he was living in that. There's no tax on that. The cottage, again, same cottage, purchase 500,000. At the time of death, it's valued at 750. So it's taxable. The extra 250 is taxable. RSPs are taxable as income at that time. So assuming he didn't make any more money that year, we're gonna go to the next page. Sorry. This would be the tax on that, assuming this is the only income he made. And by the way, I just went into, this was 2023 taxes, but it could change year to year. So the RSP is going to be taxed 278,000. The cottage, another, I believe it's 68,000. Sorry, I can't actually read my own slide here.
Yeah, 66,912.
Thank you, 66,000. The primary residence is 0, and that gives a total tax bill, which is listed at the bottom, which is about $345,000.
Yeah.
So you have to be prepared for that and know that ahead of time. The ways to avoid these tax bills to your estate. Number one, life insurance. Life insurance is actually the least expensive and easiest way to do it. They don't charge for changes if you want to make changes. It's really a very simplified way. And there's ways, like I mentioned before, you can use life insurance also to purchase the property in the first place. So there's all the advantages of it. I'm a big proponent of that. The other ones, and you would talk to a lawyer about this, is using a trust. But I recommend doing that when you purchase the property initially. So the property would stay in the trust. And then at time of death, the children become the beneficiaries of that. And you can work out any taxation or whatever based on the trust, and the trust would have my understanding is the trust would have a much lower and easier tax hit. So that's it. We had a few questions submitted. Tom, I'll let you actually ask them, so you don't have to show this.
So what I know, one of the big questions that people had is what happens when it's time to transfer wealth to the next generation? Like on your example, you showed that, when somebody passes away, the kids get it, and based on that value at that time, they get taxed. So when you transfer wealth to the next generation, does it make sense to have it transferred while they're alive? Or I know you did show us, some ways of insurance and all that, but what is your answer to that?
I would actually say it depends.
Okay.
And it's usually an individual situation, and I like to talk to people about what their plans are.
Right.
If you're transferring ownership to someone and that's going to become their principal residence.
Right.
Let's say you have kids, you have a cottage, you want to transfer ownership so they can live in it and work remotely.
Right.
Then it makes sense to transfer it now and take the tax hit now.
Right.
Because they're not going to have to pay any tax on the increase from there.
Right.
If it's going to remain a cottage property and it's going to keep growing, it probably makes more sense to keep it in the family and give it over and use life insurance to offset the taxes. But it really depends. Every person has a unique situation. I have not seen two people with exactly the same situation when it comes to this. And so I recommend speaking either to an accountant or somebody like me that can guide you through the pitfalls.
Yeah. So, on the cottage example that you said, when a parent transfers the cottage, so I think we had one of our clients ask the questions recently where they wanted to transfer the ownership. They have two properties. they were renting the second property for some time. They wanted to transfer the second property to the daughter's name. And then you had mentioned that, transfer it now. And that way, that's her principal residence. And then she doesn't get taxed. But the 10 years that our client was actually renting, based on the value she bought it from to the time that she's actually transferring to the daughter, that's the tax that she has to pay.
Right, exactly.
Right. Now, when you talked about the cottage, you had mentioned that if the parents are alive right now and you're transferring to the daughter, that cottage is also a second property to the daughter. So that's still going to be taxed for her because it's not a principal residence.
Right.
Right. Am I right?
Right. And that's the other kind of advantage of using life insurance for if the cottage is going to remain a secondary residence, a second property. If you use life insurance, then I'll use simple examples. Let's say it's worth 500,000 now. The parents unfortunately pass away. I'm sorry to hear it. It's terrible news. Parents pass away, it goes to the daughter. It's also going to grow before she passes on to her next generation.
Right.
So we also want to minimize that tax bill as much as possible, which is the growth from time of death of the parent to time of death of the child, or till when she sells it. So if we transfer it now, and it's a cottage, we transfer to 500,000, transfer the cottage, it grows to $1 million, and then when they die, goes to 1.5 when she passes on to her next generation. Now she has a tax bill for for the capital gains on the entire $1 million. Whereas if we do it, then she has a lower tax bill. So we're trying to manipulate the tax system legally. Legally, it's very, very important. You do it legally, CRA approved ways ahead of time. You don't have to call James.
No, that makes sense. So you're saying that if the value of the property has increased from 500 to $1 million when the parent transferred to the daughter, and then later on it increased another 500, she's responsible only for the 500 increase, right? And then you're saying option to set, to actually get that the tax bill reduced is through an insurance.
Right. Well, you get insurance to pay that for pennies on the dollar.
Right.
And you minimize her eventual tax bill.
Right.
After the parents pass away, it's going to go to her anyway. So there's going to be additional tax when she finally sells the property.
Right.
By the way, just as a side note, one of the problems that I've seen a lot of people have when they sell property, let's say you get property from a parent, you get a primary residence. And then they underestimate the value of that primary residence to save money on probate, which is 1.5%.
Right.
And then they go and sell the property, but now they have to pay capital gain because they're not living in the property from the probated amount to what they sell it for. So they have to pay 50% of that as opposed to 1.5%. And it's just such a simple trick to think of, but you have to know ahead of time to do it so that you're minimizing the tax bill. And both of them are legal. You have to do it by the book. But of course, there's always three values to any property today. You know this. Right? What you want to sell it for, what somebody's willing to buy it for, and what the actual purchase price is. Right. So
So no, I think there were a lot of questions from our clients and anyone who registered that, dealing with, passing on the assets. It could be cottage, it could be rental properties, while they're alive, and I think really finding solution to it, because at the end of the day, we have had cases where people had to really go through a lot of burden, not only the parents, but also the kids, right? Because they did not know that there was such a big tax burden coming up. So actually be preparing and actually talking about what really needs to be done to actually reduce the tax bill for the family, like, our kids, is important, right?
So, and on that note, much similar to what James said, anybody who calls in from this webinar or anybody who calls me and mentions your name, I'll give them a free consultation to talk about what the potential taxes are. I'm happy to do it. It's my pleasure to help them before they buy the property, so they know what they're getting into. Because if you work it right, then if there's no surprises, it's always a lot easier.
And just so everyone who registered, they are providing free consultation to everyone who has attended. And it's so key that, preparing earlier for, taxation or the state is so key. So because they are here with the webinar, and for our team and members who have registered here, they're going to offer a free consultation. Now, the other question I had for you, Brad, is,
I feel like I'm taking all the questions.
No, I think what happens is, I think James, with taxes and all, there are a few questions too. So what happens, for the estate, do I report my gain as capital or income? For example, we have sometimes people who have corporations, right? And sometimes, you know, it's a corporation, or it could be their principal thing. But most of them is, you know, looked at as an income, right? And they pay, I mean, you know, capital gains on that. Is that correct?
So, again, there are certain caveats, and every situation is a little bit different. I think James actually touched on this post facto, which is if you're buying and selling within the year, it's pure income.
Right.
It's a business transaction, or what we call house flipping. If you're buying it, using it as an income property and declaring income on that income property,
Right.
and then selling it over a period of time, it's generally a capital gain because the income that you made was what you used it for. So it's usually capital gains, but there's a lot of caveats. I would say, again, talk to me or talk to a tax accountant or James. Make sure you know what's going on before it's too late. Don't do the wrong thing, either by paying too much taxes, which is just a waste,
Right.
or by not paying enough taxes, and then the CRA comes after you. Either one is a bad idea.
Right. Yeah. Now, I know a few of our clients had asked, you know, how do you charge for your services? Because I think it's a good question for them to know. The first consultation is free. And James, go ahead and just let them know, how do you charge for your service?
Yes. Well, if someone chooses to engage with me, we do most of our engagements on an hourly basis. We take an initial retainer and hold it on deposit and draw down from that retainer as we work on your file. There are some engagements that we do offer a fixed fee, a flat amount. For the engagement, but that it depends on the circumstances, and I'm happy to talk to anyone about those services and the fees associated with them.
So in my business, financial advisors, financial security advisors, there's so many variations on how we charge for fees. Generally speaking, there's a fee to create a plan, and then any product that you purchase, you don't pay additional for those products. We do get commissions from the back end, and I'm happy to discuss those. But of course, like I said, my consultation or an initial plan for anybody that calls me through you,
Right.
I'm happy to do that for free.
Okay, good. Now, the other question is, I think we talked about it. So one of our clients had two granddaughters. One is 22 and the other one is 26 years old. Their mom is my client's daughter, and she wants to set up a will so that they will not inherit money going to them all at once when she passes away. But she likes to have them inherit like 5 to 10 years, right? So maybe some kind of trust fund. So what would your recommendation would be for that?
So for me, it's kind of very simple. There are two options.
Right.
One is, again, I keep going to life insurance. I'm sorry, I'm not trying to push the product. It solves so many of the problems. You do it in life insurance, and you actually put as in the beneficiary, you put a letter stating exactly what your intentions are.
Right.
So you have the life insurance, you know exactly how much is going. You say, I want it paid over 10 years.
Right.
And then the company is going to create something for that. You can also put that in your will.
Right.
In your will, you can say, I want it paid over 10 years. And what we do is we set up an annuity.
Okay.
And the executor of the estate, if you get the executor to do it, they can do it. The problem is then the estate has to pay the executor every single year, as long as that trust is in place.
Right.
And the executor, I mean, I don't remember, I think it's 1 or 1.5% per
Right.
year,
Right.
but whatever the amount is, they have to earn that money.
Right.
It might be significantly more. I'm not an executor. We have them at Farber, but it's something that's it's important to consider all the options. And so probably I would say for that client, call me, I'll walk her through it.
Okay. And I know, can clients give income from real estate for example, they have an investment property that they have invested in the kid's name. And these kids are like, between 13 to 17 or something. The income that is, so the property is sold, and then there is income that has come in their name. Now, mind you, they're 13 to 17. Is that income that they can actually show in the kid's name?
talk to an accountant. I was trying to say this is a very, very complex thing because under 18 years old, generally speaking,
Right.
you have to prove that you didn't provide the money to the kids.
Right.
And if you bought a property for them at 13,
Yeah.
it's the CRA is going to say, no, you bought it for
Right.
them. And so it will go on your taxes, even if you report it in the kids' names.
Right.
And the CRA is going to say, oh, an 18-year-old that just made $400,000.
Yeah.
Yeah, I would advise to be very careful about that.
Okay. Now, the other question is, when you transfer a property from an estate to a daughter, right? Would it be possible to transfer at a lower market value? I think you answered that question before. It has to be the right value because CRA has ways of appraising the property at the right value. It could be like off here and there because I know it also depends on the market because in 2022, the market was peak. Now, based on the question that one of our clients asked, now they want to transfer the money from her to the daughter, the property from her to the daughter right now. Now, depending on the location, some areas the prices have kept that price, or some areas the prices have gone down. So when we look at the 2022 pricing, and if she's transferring it right now, if there are some properties that sold for the 22 prices currently, we can still give that valuation at that time. Is there any other way that CRA actually checks that valuation?
That I'm talk to an accountant
Right.
about that. I'm sorry. It becomes a very fine thing. From my perspective,
Yeah.
a simplified way of doing it is, if you call in 3 real estate agents to value your property, there's going to be a slight difference between the valuation. And I've seen this a lot in divorces.
Right.
In divorces, the wife calls one and the husband calls the other, and one's very high and one's very low.
Right.
And shocking, they're both legal. Right. And so if you're transferring property in a way that you are going to become the principal resident, that's going to become your principal residence, it's better to transfer it at a lower value.
Right.
If you're going to transfer it that it's not going to become your principal residence, you're eventually going to sell it, or it's going to be your cottage property,
Right.
I would actually do it the other way and say, no, transfer it at the higher value, because it'll make more sense in the long run to save taxes later on.
Correct. Yeah. And now the other question is it when a family like a husband and wife is actually buying a property, is it better for them to buy an investment property under their name, or should they form a corporation and then buy it under the corporation's name?
So my kind of rule of thumb, this will be different for every single person, every single advisor you talk to.
Right.
There's really 2 answers, but people will have it differently. My rule of thumb is if you're going to do one, it doesn't matter.
Right.
If you're starting with 2 or 3, if your plan is to do 2 or 3 properties, put it into a corporation early.
Right.
Because putting it into a corporation, you reduce the amount of tax on the gain.
Right.
You can buy and sell properties, and it's within the frame of what the business is.
Right.
And you can protect the assets a lot easier within a corporation. It's harder to get a mortgage off of it.
Right.
I get that.
Right.
But once you have the corporation,
Right.
it makes more sense to keep those kind of investment properties. Also, all the income goes in, it's only taxed at 12 to 15%,
Right.
as opposed to your personal income tax level.
Right.
Right.
Yeah.
So it can make a big difference.
Right. Now, I know, James, you haven't answered any questions so far. So the
I
question
feel
I
bad.
had is,
Sorry.
No, that's
the
okay.
question that I had for you is, we were talking earlier on, people get audited when they have, and you can expand on it, when they have separation, divorce. So give us scenarios, what are the most likely people, and then somebody calls, the other spouse calls and reports, right? So expand on that, please.
Well, yeah, you have, that sort of touches on how the CRA chooses files for audit and how that goes about. There are certain things, I used to work in the workload development area of the CRA for a while. There's sort of a risk profile for everybody. And like, for example, if you haven't filed a tax return for many years and then you file a bunch of them late without going through voluntary disclosure, those are more likely to be audited. If you file a return and then adjust it later, that is more likely to be audited. But the more interesting, the CRA has something called the leads informants line, and it's known informally as the snitch line. And so I guess in general, I would say that there's a lot of ex-spouses or, bitter husbands, bitter wives that during a divorce, they may call the CRA, they may call this line and report on their spouse in terms of all the potentially illegal things that they may have done in terms of tax evasion that when you were happily married, you were happy to tell your spouse about, and now that you're going through a divorce, you may regret it. So that's one of the more common sources of leads: bitter spouses, bitter, bad business relationships, partners, and even jealous neighbors. Really, if they see that you're living quite a wealthy lifestyle and they're not quite understanding, that you may not have made that level of income to support that, then they may call up the CRA too. So in general, I guess if you want to reduce your chances of audit, stay married.
Yeah.
And don't show off.
Right.
And I think the other one, that example you were discussing, is where I think one of the parents or the daughter wanted the mother to move close to where they are, and then they sold, and then CRA audited. So give us an example on that too.
Yeah, I mean, when you have two properties, and one of them is a principal residence, and another one, say, a vacation property, a rental property, what have you, you can change it. So in this case, they wanted to have the mother move into the cottage and make that their principal residence, and that has tax implications in terms of the change of use. There's a deemed disposition and likely a gain that goes along with that. Now, the concern the person had was that was going to create a very large tax liability on their personal tax return the following year. And they were worried about what the CRA would do if she could not pay that debt anytime soon. So she asked me, well, maybe it's better to not file the tax return. And so I told her that was a bad idea. Not filing a tax return is by far the more serious transgression than owing money to the CRA. Owing money to the CRA is not illegal, and there's ways to deal with it, and that's what we do here. I've even hired a former CRA collections manager to handle those negotiations with the CRA because they can be done, but the collector's not going to tell you what the rules of that game are, but we do know them. And you can term out the payment of taxes over quite a long period of time, believe it or not. They will continue to charge you interest, just like any other creditor, but there are other ways to try to reduce interest and penalties on a debt as well. So the bottom line is, file your tax returns on time. If like I said, the first day that a tax return is late, it's a 5% penalty on the tax owing. So it was $100,000 tax bill, you've got a $5,000 penalty immediately, and that goes up from there. So filing on time, even if you don't pay, will help you avoid that late filing penalty as well.
Right. So I know, so our time was about 45 minutes. So we have a lot more questions. So what we're going to do is, I think Charu from our office had sent you a link where we are forming a WhatsApp group, but we are going to get all those questions, and we also have this recording that we could send to each one of you, and we'll be posting some of the answers there. But what is so key is, for James and Brad, they are there as a free consultation to actually call them and talk to them. We'll send you their contact information as well. And on our WhatsApp group, you could also ask some questions which may have been answered or we have questions about. And it's so important because, we come across estate issues, tax issues on an ongoing basis with our clients. And, there is one of our clients, and it's so important to have a will to begin with, because we had one of our clients that I've been telling them, they're, retired, an older couple. I said, you need to get the will, and they didn't have any kids, but they kept prolonging it. They did say, I really have this person I really want to do, I want to give to my sister, and the kids are handicapped. She didn't do, both of them passed away.
Oh.
So then the estate looked at who are the siblings around there, and finally who actually got their property, all the income that they had, was somebody that they didn't want to get.
Right, because if the government, if this is something actually, it's very personal to me. I at the bottom of all my emails, I don't know if you've seen this, I do not sell wills. I do not write wills. I am not a will and estate lawyer. At the bottom of every one of my emails, please get your will done and get it updated.
Right.
It is a very personal thing to me. It's very important to me. Even if you do your will now and say, you know what, I want to change it, it costs less than the amount of problems you're going to cause by having your money go to whoever the government decides, because the
Right.
court gets to decide. They have a list,
Right.
they go according to the list,
Right.
but they get to decide.
Yeah.
My aunt actually passed away last year,
Right.
and she didn't have a will.
Right.
She was writing one, so I know exactly what her intentions
Right.
were. My sister and I were the only living heirs.
Right.
So we had to file for probate. We were going through all of the things right now. It takes a long time. It can be between 6 and 18 months to get it filed.
Right.
Then you have to find out what information is there, how much is there. By the way, something that I do offer to every one of my clients for free is I have a fillable PDF.
Right.
I send it to you. You keep it. You don't have to send it back to me.
Right.
It says, what do I have and where is it?
Right.
I have a bank account at Scotiabank. I have an investment account at BMO. Whatever you have,
Right.
obviously I should be in there somewhere. But whatever you have, you take that list, you print it out, you put it in your safe, or
Right.
you share it with it. You don't have to have all the account numbers. You don't have to have the amounts that are there. People don't need to know what you have,
Right.
just where you have it.
Right.
Because then when something happens, they can go with the will or with the probate certificate and say, so-and-so passed away. I'm very sad, but can you please tell me what are the next steps?
Right.
Every bank, every city has an estate department.
Right.
They all are there. They're not necessarily great, but they're there to help you. And they'll walk you through the process. But if you don't have the will and you don't know where to look,
Right.
my aunt actually, we happened to find a letter in her apartment
Okay.
that listed her some investments.
Oh.
I think that's all she had,
Right.
but had I not found the letter, it would have been
Yeah. That'll
nothing.
Yeah. So yeah, so it's so key that, based on what Brad and James have talked, really get those papers. And I'm hoping that, Brad, you would be able to send us that PDF we
Sure
can
thing.
pass on.
Sure
So
thing.
we'll send you the copy of the PDF that he's going to send us, and also all the answers that, and questions that you've asked, which have not been answered because it's already close to 8 o'clock. And we also have links where we want you to email us, which is like, guide to estate planning, 5 things you should avoid to getting audit. So all these things we have compiled, and we'll put it together so you can actually go and let us know if you want that, and we'll send that to you. But otherwise, I think, I wanted to thank Brad and James for coming over, giving real valuable information to all my clients, everyone who registered. I mean, we even have our associate agents who registered, and we want to make sure that we help their clients as well. And so it's so key that we keep this platform alive with questions, because if we can help each other, and the ultimate goal there is to help our clients and people who don't have that information, so they can actually keep a lot of the money that they saved and pass on to generation, with less taxes, right? That's our key objective here.
My objective in life, besides helping people sleep better, to know that their money is there in retirement, that they can spend, share, and use their money, that's great.
Yeah.
But my objective is to make sure they can do it with the least tax paid possible.
Correct.
I love that government provides services. I think it's great. I think that people do have to pay taxes, but my goal is to help my clients pay the minimum amount legally.
Yeah. And then whenever you get audited, James is here, right? And you need to go to him before. I mean, he's providing a free consultation, right? So it's so key that we provide, we gather that information that James and Brad is going to provide. With that, I really want to thank everyone who has joined, and please send us your questions, and please send us the information that you require. Go into the email and send us the links that you want, and we'll be all glad to help you out. Thank you. And on closing remarks, we also have, upcoming a stager, an inspector webinar coming. A tax lawyer is also going to be talking up. So watch out for those webinars that will be coming up as well. And we would love to give you as much information as possible, so you have a less stress-free life. That's the key, right? Good. Thank you.
And thank you very much for having us. We really appreciate
thank you so
it.
much, Tom. Thank you, everybody, for attending.
Thank you.
Yeah, and also, if everyone who has, joined this, we would love to get a 5-star Google review. And Chara is going to send you the information for the link. Just put there, you loved this webinar, give us a 5-star review, and we would love that. Thank you. Appreciate that.